there's a fixed number of buyers per year. So there's a number of people who need to buy a home, and they're going to buy a home either this year or they're going to push it to another time. Q3 and Q4 of 2022 were really low as far as closings, people actually going through with the purchase of a home. Those people didn't just disappear. Like, there are still going to be buyers. They just became future buyers.
If things like inflation starts to get more under control, interest rates start to come down, companies stop cutting jobs and maybe even start hiring things so that people feel confident in their job security, it wouldn't take a whole lot for the market to turn around really quickly. Welcome back to the podcast. Today I am joined by Tom Hallock of Loan People. How's it going today, Tom?
Doing great. Thanks for having me, Troy.
Great for having you back on. Got the name right and all that, the name and the business name in one take. So it only took us to episode 2 with you on to have all that down. I know, getting into it right off the bat, the big kind of information in our world was the CPI data that came out yesterday. And unfortunately, it showed a small uptick in inflation, nothing crazy, still down from the highs of late last year. But what was your kind of takeaways from that data and how it might impact interest rates?
Yeah, that was definitely not what we all wanted to see necessarily. But I talked a little bit about this with people, which is like CPI is a rolling 12-month average. And so when we get January's inflation data, which is what came out yesterday, it's dropping off 2022's January. And 2022's January was one of the lowest months. So not unexpected, but at the same time, the market reacts to what the market reacts to, which is it doesn't look great right now. But I think over the coming months, it's going to keep trending down. But right now, rates are mostly flat over the course of 2023, as opposed to like big drop-offs we were hoping for. But that being said, I think the trend is still going to be downward as these reports continue to come out. So a mixed bag, not what we necessarily wanted to see, but also not super unsurprising. But what was your reaction to it? What did you think?
Yeah, the same thing. I know we had also talked about last time how interest rates are driven by a number of different factors. And so this could be better to potentially help interest rates and might mean that the Fed, I don't think anyone really expected the Federal Reserve to lower rates anytime soon. It might cause them to feel like they still need to raise them a little bit more, but that doesn't necessarily mean mortgage interest rates won't stay relatively steady, because you had talked about kind of spread of what investors are needing to really feel comfortable giving loans, and the market has eased a bit that way. It's also not like that. I also am usually trying to run data on the housing market numbers here in Austin, try to run them before Board of Realtors actually puts them out. And looking at that for the city of Austin, saw that home prices actually were up fractionally about 1.5% compared to January last year. Now, volume was down, less homes being sold, but I don't think a lot of people would have necessarily predicted that. And so to me, it shows that things are relatively stable. Again, not seeing a ton of positive news signs and news. It feels like people have to overinflate whatever the news is, whichever way they want to go with stuff. And so it's one of the reasons I don't watch a ton of news, but it's like, if it's that 0.1% higher on inflation, suddenly it's, inflation rose, or if
everything's going crazy.
It's just interesting, but it feels like things are at least relatively stable. Like you say, we got to get rid of, for the CPI data, we got to get rid of these numbers from early 2022 that were really good to really get to see where that average is truly at.
And that's a great point. Is one of the big names in mortgage rates and for the data that goes into tracking them is Barry Habib. And he said that these numbers are going to be a little mixed at the beginning of this year, which has been true so far. But then he said come April, May, when those inflation numbers were really bad last year, once those numbers start dropping off, we're going to see rates come down pretty precipitously, he thinks. Who knows? There's also potential for other data other than just inflation, which is fun to realize because, I think we talked about this briefly before, but inflation is the big metric that everyone's looking at right now. But then there's jobs numbers, there's international data, there's other events that can happen in the world. And so it's all eyes on inflation for now, but it's also important as we ease out of this, hopefully, knock on wood. That's not going to be the only thing that people are looking at as far as like where mortgage rates will go. So,
Now going back to my less than stellar reviews on news and national media, one thing that was in favor for real estate agents and mortgage loan officers was some data that I saw showing an uptick in mortgage applications, and some organizations talking about that being because interest rates dropped marginally, and that being such a good sign for the market, which don't get me wrong, if rates are dropping a little bit, that's great. We'll take it. But it's not really how I read the data at all. Like, you can kind of read or imply a lot of your own opinion into data sometimes. And in this case, the headlines made it seem like, oh, because rates came down 0.25%, suddenly people were jumping in to buy homes. And I'm like, that's not making a huge difference in people's decisions to buy or sell a home.
Yeah. And it's funny because I always, in my head, so this isn't necessarily true, but in my head, I always think of it as if there's a fixed number of buyers per year. So there's a number of people who need to buy a home, and they're going to buy a home either this year or they're going to push it to another time. Q3 and Q4 of 2022 were really low as far as closings, people actually going through with the purchase of a home. Those people didn't just disappear. Like, there are still going to be buyers. They just became future buyers. And so at some point, a lot of those people are going to jump back in. And I know a lot of real estate professionals are saying this right now, and it's true, which is if people are waiting until rates come down, they're going to be in the fray with a lot of other people who put off the same decision. So if you can find a way to win in this market, which is maybe you have more negotiating power with the seller, something like that, then you can always look at refinancing in the future, and that way you're in a home when there's more of a frenzy out there of people who have been hanging on, waiting until the rates came down. So
Yeah, no, 100%. Yeah, again, some of the research that I do to stay on top of the market, I think I'm going to potentially try to do a video on some of it that I found. But right, like, inventory levels are still relatively low. It just feels like they're much higher because there's actual inventory out there, which there wasn't for the last 2 years. And so it's, oh my gosh, there's homes everywhere. But that's not really the case. If you look over the last decade, we're still at some of the lowest inventory that we've been at. And so if things like inflation starts to get more under control, interest rates start to come down, companies stop cutting jobs and maybe even start hiring things so that people feel confident in their job security, it wouldn't take a whole lot for the market to turn around really quickly and for situations to be not the same as they were the last 2 years, because there are a number of other factors that aren't going to be the same that way, but to be another really hot market like it has been in Austin for most of the last decade, even prior to the pandemic and all the transient nature of people moving here because of new work from home things and COVID and stuff.
yeah, and I think we talked about this off camera at some point, but to me, there's three pathways always, which is you either think rates are going to go up, you think they're going to stay the same, or you think they're going to go down. If you think they're going to go up, then now's your best chance to buy. So you've got to do it as soon as possible, because it's just going to cost more to buy the same house in the future. If you think they're going to stay the same, there's no advantage to waiting. It's not like you need to rush, but at the same time, why would you wait to initiate home ownership? And if you think rates are going to go down, that just means that there's going to be more people jumping into the market in the future. And that means you'll have a refinance opportunity in the future. So you can have negotiating power now and get in there. All signs kind of point to, like, trying to time the market is going to be a fool's errand. Like, no matter the pathway, you can be a winner right now.
Again, trying to time any market is basically not a good recipe for success. You would, if interest rates really did rise up a bunch, the counter argument would be that home prices have to come down because of affordability concerns. But again, in what I'm seeing in the ground level with homeowners is they're able to decide, hey, we don't really want to sell, or it's challenging because all the buyers have left the market. We'll just turn around and actually just lease the property out, because if we bought
Right.
3, 4, 5 years ago, we can easily cover our mortgage with where rent payments are at right now. So
Exactly. And who's
homeowners
paying that rent?
yeah, exactly, the people that don't want to buy homes. And so again, it's a tricky balance. I have a couple clients as well who are a little bit on the fence because one works at Amazon, one works at Google, and they're just had 12,000 and 18,000 people layoffs. And they're, shoot, do I really want to buy a home and then suddenly find out that my job is being cut 6 months later? And so I get that part of it, wanting to be a little bit more, again, that's why for me, I think the job security portion is the tipping point. Once people have that in their mind, then I think there's going to be a lot more people that enter the market. And if you don't have that job security, yeah, it may be challenging to want to buy a home, but for most, especially first-time home buyers, it always feels a bit challenging, a bit overwhelming, stressful to buy a home, because you're making a commitment. You don't want to be selling in a year or two, because that's not a money-winning strategy at all. And you're usually going to have a higher mortgage payment than you have a rent payment, But the advantage is that you're kind of locking that in long term versus riding the rents that have been continually increasing over the same amount of time that homes have.
Exactly. And you're getting the tax benefits and you're contributing towards your equity. But as you mentioned, that should be a longer play in most cases. But yeah, you're exactly right.
So one of the other things that I had seen in some articles was that there's a study out there where apparently 67% of Americans believe that the real estate prices will crash in the next 3 years. And I can only think that that is the case because of, again, news media and other things. Again, and it's most people shouldn't get into the weeds about real estate like you and I do. It's not their job. Like maybe you need to look at if you're buying a home or selling a home, or if you own a home, stay on top of it every once in a while, but it's not necessarily worth getting way deep into it, even though we find it fun. But it's one of those things that once you are there, this is where I do think it's valuable to have connections that are actually boots on the ground, right? So like instead of listening to a CNN article or even a Forbes article or all those kind of things, don't even just listen to KXAN here in Austin, but have a realtor, have a mortgage loan officer, have people you can reach out to and talk to periodically to see what they're actually seeing in the market, because they're going to have a better idea of when things turn around rather than these national news organizations looking at data that's 3 months old, 6 months old, making up stories because they want clicks on their website so they can continue making revenue.
Exactly. Yeah. And you're exactly right. I think, and we talked about this off camera again, which is sometimes those articles are just meant to drive clicks because they know people are going to go on there and say, that's not true. People like to think that there's going to be these giant similarities between right now and 2007, 2008, 2009, that time frame. And it's just a completely different world. And that starts with the lending world is so vastly different. And we talked about this on the last podcast, is just that you actually had to qualify for a loan rather than back then when it didn't matter if you had a pulse, you were going to get something. And now you do have to prove some things. You do have to show some documentation. And that's been a good thing. That means it's been metered growth. That means it's been there's some fundamentals to the numbers. It's not just like the numbers came out of nowhere. Yeah, exactly what you're saying is what I see on my side as well.
Yeah. And again, right, the fact that Austin, I don't know the specific numbers, but Austin had these projections of where it would be size-wise in 2030. And two of the biggest reasons for the increase in prices, yes, the low interest rates, so it made easy money. But COVID, one, because you suddenly now were at home 24 hours a day, 7 days a week for a year and a half, meant that home was more valuable to you, not just from a net worth standpoint, but from a livability, quality of life standpoint. And then two, you had a lot of people that weren't having a good quality of life in a condo in New York City or a condo in San Francisco who are like, let me go find a place where I can the parks are open, where I can have a little bit more space in my house. And so people that would have eventually moved to Austin over the course of a decade suddenly did it in the course of a year because of that. And so there are some very specific reasons why home prices did what they did, not necessarily going to be reversed, because I don't see companies requiring people to move back to San Francisco, requiring them to move back to New York. And yes, there are some people who might realize, hey, I enjoy hanging out with people. And so this 4-bedroom house that I bought all the way out in Liberty Hill is too far away from the people that I enjoy hanging out with. Let me sell that and move back into an apartment in the city if they want to. But it's not going to be a substantial enough number to suddenly have home prices crashing.
Plummet. Fall out of the sky.
Yeah, plummeting. Yes, exactly.
And you brought about a good point, which is those people who are making those decisions right now, you mentioned this a little earlier, is just sellers are getting to choose a little bit more when they sell. If you bought prior to 2020, then you still have a pretty sizable equity gain over the last few years. So like they're sitting on more equity, even if prices relax a little bit more. And then also if you refinanced or you purchased in 2020, 2021, and you have a crazy low interest rate, like a lot of those people aren't willing to let that go into foreclosure. They're going to do everything they can to keep that, because that in itself, having a mortgage with that low of a rate is an asset in a way. It's just, I don't think there's going to be that willingness of people to let a property go. And I don't think we're going to see, there's always an uptick in foreclosures when there's a downturn in the overall market and the overall economy.
Sure.
But at the same time, I don't think it's going to be this giant spike that we'd seen in the past.
No, and so again, that goes back to the article I was mentioning. So was a spike in pre-foreclosure kind of scenarios, because it didn't increase. I don't remember the specific percentage, but it has increased quite a bit since 2021 in the last year or so. But the percentage of people in that pre-foreclosure stage is still 80% below what it was in normal times, 2010, 11, 12, and like 200% below what it was in 2006, 7, and 8. And so again, that's another one where you can be like, "Ooh, have a headline, ooh, there's an uptick in foreclosures." But that doesn't really tell the whole data, because it's still, other than, again, the last year or two when it was at the rock bottom levels, it's up a little bit from there, but really we're at lower levels than we've seen since pre 2020, or excuse me, not 2020, since pre 2002. So like for 20 years, we haven't seen this low of levels in pre foreclosure activity. And so that's another example of why you're not going to see this plummeting real estate market crash.
Yeah, it's such a great point, because I think about things, and there's not a fixed number, but there's an average number of things that happen per year. So there's an average number of foreclosures that happen every year. There was essentially a moratorium on foreclosures through 2020 and 2021. Those foreclosure situations, those people going through those situations didn't necessarily just disappear. So yeah, there may be a spike after that goes away, but that doesn't mean that the spike is now going to become a mountain. It's just those things were built up over time. And so there was a bump coming out of that. But yeah, a great point that those situations hopefully aren't normal.
Yeah, they're
that we're have a 2020,
but it's not, it's not the doomsday scenario that some people want to make it out to be, for sure. Speaking on that, talking about people being hesitant to get into a home because of the job security, or someone who's lost their job and now doesn't know how to make their mortgage payment. I know you don't specifically deal with servicing, but I think it's important to talk to people about options they may have if they don't feel like they can make a mortgage payment, or are worried about being able to make a mortgage payment. Because I think, again, a lot of people, if you're not in the weeds like you and I are, then you just think, well, shoot, I just can't make a mortgage payment. But they don't realize that most mortgage service providers, the people that are actually collecting your payment for the mortgage, they have systems in place, because they don't want to own your home. That's the other thing, is, oh, the bank can just own my home because it went into foreclosure. None of them want to own your home. They want someone who can pay a loan. That's what they're set up for success. And so a lot of them have programs to potentially provide some assistance, either with delaying payments, suspending payments for a period of time, and doing things to help ease that transition. So maybe if you lost a job for a few months or whatever that may be, maybe you have some more information about that, because it's not something I've specifically looked into really recently, but I know that's out there for homeowners.
You're exactly right. And it's not my specialty, but servicing is something, and you said the most important part of it. Loan servicers, they don't want to own your home. They want you to keep making payments. That's how the whole system is set up to make money over time. So yeah, if there's a situation where someone doesn't think they can make a payment, if they lose their job, if there's a financial hardship, it's really important to reach out to your servicer, because each loan type is different. There are different types of workout plans in a lot of situations, but it's important to reach out before just missing payments. Because if you start missing payments without contacting your servicer, that becomes a much bigger issue, because that's something that is going to affect, first of all, it's going to affect your credit over time, because 35% of your credit score is on-time payments. So don't put your future self in that situation by just letting that happen. But most of all, reach out to them. You won't know, and I think this is the theme of what we're talking about, you won't know what programs your servicer has available until you ask. Just ask, call and ask, and talk through it with them. Because we'll call it a silver lining of 2008 and COVID in 2020 is a lot of these servicers were forced to set up programs to help people work things out. So maybe in the past, a servicer would have just, not taken the call and initiated some sort of foreclosure proceedings. A lot of them are now like, no, let's work it out. We'll figure it out. And then we'll see what we can do to keep people in homes and keep them on some sort of reasonable plan going forward. You're exactly right.
Yeah, exactly. Like I say, it's not either of our forte specifically, because we're not mortgage servicers, but I'm not aware of any mortgage servicer podcasts out there. So I feel like it's getting the news out there, getting that information out there, that don't get me wrong, it's hard for a lot of people when there's change or when there's high stress. Like, a lot of us tend to freeze in that scenario and kind of put our head in the sand. But that's the worst thing you do, because once you do start to have the late payments, not only does it affect your credit, but now you start to trigger some things in those loan docs that might mean they have to foreclose on a property. So yeah, ask questions, reach out to the service providers, because the way they make money is by you making your payments.
And even if you heard a story about someone calling their servicer and getting shut down or something, every situation is different. Every loan is different. Every servicer is different. Just ask the question, make the call. It's worth it, which again, I think is a theme of a lot of the stuff we talk about. Don't just read the headline.
You hear the story about, oh, they didn't help me with my thing, but they forgot to mention that they hadn't made a payment for the last 6 months. So they're like, yeah, you're too far down the road. You rarely get the whole picture. So
those little details slip through the cracks sometimes.
Kind of important details, exactly. One of the things, speaking of reaching out, one of the things we were talking about before we got started that I think is important too so it's not just if you have questions or concerns about missing a mortgage payment or something like that, but that if you're thinking about real estate, whether it's buying a home, selling your home, whatever, is that you should you definitely should reach out to, again, a trusted real estate agent, a trusted mortgage loan officer, a financial advisor, because there's a lot of information that isn't necessarily widely known that can then prohibit some people from making the decision to buy a home. And so you had talked about a story or two of some people who didn't realize you could buy a home with less than 20% down.
Exactly right. And to start this conversation, most of the conversations I have with people, they start 6 to 12 months before an application is even taken, because it's just about getting information, understanding what is out there, and then going from there. But yeah, I've gotten a lot of emails of people saying, oh, I'm planning to buy in 3 or 4 years because I need to build up to get that 20% down payment. Most people, first-time home buyers, can get a conventional mortgage loan with 3%. Now, there are caveats, there are ifs, there are thens, but at the same time, that's something that is possible for so many homeowners. And if they're waiting that long to get that 20% down, they're going to miss out on equity gain. They're going to miss out on the tax benefits. It's one of these things that, like, the sooner that they talk to a real human about it to see what their situation can allow, then the sooner they can know exactly what to expect and maybe change their goals, maybe move their goals up. So that's something that I've run into a lot recently, is people saying they're waiting till they have more. And now is a great market for buyers because there's more equilibrium than we've had in the last few years to be able to say, oh, okay, maybe I do qualify with less down and maybe I can ask for some closing costs from the seller. Whereas if rates come down and the market gets hotter and sellers are less willing to participate and less willing to negotiate, then it makes it a little bit harder.
You may miss out because you have to go back to maybe multiple offer scenarios. Again, I don't think it's going to get to the 20 and 30 offers on a home like it was the last couple of years, but even just 2 or 3 offers on a home where suddenly you only have 5%, 3% to put down makes a difference if that other person has 20%. So then it can be tricky to win a multiple offer situation. But for most people, for a lot of homes right now, you're not seeing that a lot. And so you have, again, more negotiating power, more flexibility in your circumstances now than you've had in the last at least couple of years. And honestly, even I would say even going back to probably like almost 2015, 16, the most negotiating strength you've had in quite some time.
Yeah, I think even pre-COVID, Austin specifically had and you would know this, there's been such a low amount of inventory for so long that, like you said, if a market equilibrium is 6 months of inventory, we're at 3. That still means it's a seller's market, but at the same time, that's 2 more months than we've had. So it like take the win.
Exactly. Very much. Wanted to again, speaking of what people don't necessarily know, and again, I don't know how many people will listen to the podcast and then suddenly remember a unique loan product 5 years down the road, or hopefully 5 months down the road. We'll say 5 months down the road when they're ready to actually purchase a home. But one of the loans you had mentioned that is a little unique that people probably don't know about, but also one of the reasons they don't know about it is that it's not a loan that everyone can qualify for because the situations have to be right, but is an investor cash flow loan.
Yeah, exactly right. And so these type of loans are still available. It's for a little bit more sophisticated of an investor usually, but there are a lot of people who maybe they're self-employed, they write off all their income, so they can't income qualify for a traditional mortgage, but they want to buy an investment property. They want that next investment. These investor cash flow loans, if the total monthly payment is going to be covered by the market rents, then that's the income qualifying. So there are sub parameters and things beyond that. But at the same time, that takes that income qualifying piece out of it and boils it down to just those numbers. So there are some more sophisticated products like that are still out there that people can take advantage of. So that's, I know we're talking about two ends of the spectrum where it's like first time home buyer can put a lot less down. And then there's also these more sophisticated investment property products where people can qualify for something that they may have thought that they couldn't. Again, it's just asking the questions, talking with professionals in the market about your specific situation, because every situation is different. I'm sure you see this on the realtor side too, which is everyone's unique. It's so easy to think that you can paint with broad strokes, but everyone's scenario and situation is just a little bit different. And those little differences can be a big factor in whether someone can buy a property right now as opposed to waiting.
Yeah, that, and again, I know for you and for me both, we're happy to have like quick answers to different things, right? Someone, oh, do I need 20% to purchase a home? No. But in reality, it's why it's important to have a little bit deeper conversations, because, someone who thinks, oh, I'm self-employed, but right off all my income, would I be able to get a loan? Like on first blush, that's no. But if you don't realize that part of their self-employment is that they own other investment properties, so they have that history of showing they know how to manage investment properties. Now, maybe now we can actually do something for them. And so I think a lot of people want just the quick type into Google answer, when if you provide more information, provide the whole story of what you have going on, then suddenly there's a loan product or a property area or different things that might be of value, because we know the whole picture, where you're not generally going to bring up that product, especially if it's the first time home buyer, right off the bat. Okay, you're not going to work. You haven't had an investment property before. We're not going to trust
Right.
you that you're going to be able to manage this and make money off it, because it's not as easy as just getting rent in and stuff. But really sitting down and having an idea of that full picture is a huge benefit to providing the best advice to a home buyer as possible.
Yeah, no, exactly right. Knowledge of what is out there, knowledge of your situation is huge. And I know I mentioned that usually I'm talking to people 6 to 12 months before they even apply. There have been cases where I've talked to people years and years before they've applied, but at least they knew what goal they were working towards. And when the time came, they had that knowledge, they had that power, and they were able to go into a situation with that ready to go. And then sometimes you have that initial conversation and the next day's an application, and then they're making offers that weekend. It's as soon
Right.
as
Yeah. When you
yeah,
suddenly
as soon as
realize
you
you don't
have
need
the
the 20%
information,
down, you're like, oh, great, we can go shopping this weekend. That's amazing.
why not? Yeah, and I've had clients this year where they weren't sure what they would qualify for. They didn't know whether it was time, whether it was right or not. They didn't know if they had enough money. We talked through it. We got an application, and literally they were shopping that weekend. So it's just one of those things you got to talk through.
Yep. Not the knowledge is super, super helpful regardless of the direction you decide to go with it.
Definitely.
Cool. Well, I appreciate you jumping on the podcast this time, and always fun talking to you. And so looking forward to do it again soon.
Thanks for having me again, Troy. I always enjoy it. Thank you.